Well, here come the hawks. A week of Fed comments coming in shortly after surprisingly strong economic data, including, of course, that hot jobs report. The takeaway, the Fed is unlikely to relent in its aggressive fight against inflation. Now, let's take a look at some of those comments this week with, of course, Fed Jay Powell as the baseline. We saw most Fed speakers aligned with his comments, with John Williams calling rates of 5 to 5.25% appropriate for the year. Neel Kashkari, though, on the more hawkish side of comments this week, saying the January jobs report indicated the need for more hikes. Now, of course, all of this showing a Fed that's more willing to consider keeping rates higher for longer or even raising rates further. The move set to continue putting the squeeze on businesses that find it harder to borrow from banks. Well, let's take a look at where all these Fed comments leave markets. Joining us now is Cameron Dawson, Chief Investment Officer at New Edge Wealth. Good to see you, Cameron. So, as we look at what we saw from these Fed speakers in force, mostly hawkish, but then how do you square that with this ongoing market rally that we're seeing when you have these easing financial conditions saying more hikes are coming?
Yeah, it's really interesting because what we see is the bond market is starting to wake up to this very hawkish Fed speak. We saw the 2-year yield jump after that strong jobs report. And as we've had all this hawkish Fed speak, we've also seen real yields start to climb. But we haven't seen any wobble within equity markets, which just means that equities really aren't pricing in this policy path that bonds are starting to now. And so we think that now that equities have had this big rally, you've seen valuations expand tremendously just to start this year, which does leave them vulnerable if that equity market eventually starts to wake up to this Fed policy path, meaning that there could be renewed downward pressure on valuations.
So then, Cameron, if markets think they've priced risk in correctly or not, then what's really behind this rally then, and are you buying into it?
Well, we haven't seen any support from the earnings front on this rally, meaning that earnings estimates have been getting cut throughout this rally. All of the rally has been driven by valuation expansion, multiple expansion. So if we look at the S&P 500, we're already back up to about 18.7 times forward earnings, which is really rather expensive from a historical perspective. Now, there is historical precedent for valuations to rebound long before earnings do, long before the overall economy does. But the reason that happens is because usually liquidity is expanding, meaning that when earnings are really weak, the Fed's just throwing money at the market. And the thing is, we've seen this big valuation expansion, but liquidity really hasn't been expanding. And so we do think that without a true pivot by the Fed, if the equity market doesn't get what it wants with rate cuts, then those valuations are simply too high.
And so then, for people trying to make sense that obviously the rally that we've seen coming into the year, then what have you been rotating in and out of as you really try and seep through the tea leaves here to find out and go really beyond the noise that you're hearing out here?
Yeah, we've stuck to our quality bias. It has caused us to lag starting this year, meaning that we haven't chased the big rallies in lower quality, speculative, high beta types of names, and instead kept with names that have strong balance sheets, generate a lot of free cash flow. And in markets like this, we will lag. But what we think is that we're finding opportunities still where valuations do remain well contained in some of these quality names to be able to build positions for the long run, and we'll continue to buy more of them if prices do weaken. So we're not in the camp that we really want to be chasing the rally in the most speculative parts of the market, simply because, again, we don't have that kind of liquidity support. So we're sticking with quality, even though it's meant that we've lagged to start the year.
And we know that markets have sort of jumped with every sort of bit of weekly or monthly data that's come out. And you're, of course, keeping an eye on the CPI data that's coming out on February 14th. What are the expectations there and how you think the markets might take that?
Sure. Well, we see potential for CPI to possibly come in hot next week. If we look at the two biggest sources of disinflation through the back half of 2022, it was gasoline prices and used car prices, which all fell pretty consistently through the back half of last year. But starting in January, we've seen gasoline prices climb 12%. We've seen used car prices up 2%, which just means that those big sources of disinflation might start to be moving in the other direction. So we think that this could be a hot CPI report and a reacceleration in that month over month inflation. We think month over month is more important than year over year because that has the skewed by base effects. So we're watching that very closely because what that could essentially do is create more urgency by Fed policy members to talk really, really tough if that inflation starts to reaccelerate.
I'll certainly be looking for that, especially after all that disinflation talk we heard from Powell really setting off the markets at the moment. Cameron Dawson, great to have you on as always, Chief Investment Officer at New Edge Wealth. Thanks so much.